Hello and welcome to Advanced Projections October 2020 Economic Report. Let's start out with our forecast reviews from last month. We said that our expectations for COVID cases and fatality tolls would continue increasing through the end of summer, i.e. late September. As of now, October 6th, U.S. cases reached just shy of 7.5 million, an increase of 1 million in the past month. U.S. fatalities have reached 210,000, up approximately 20,000. Fatality rates remain stubbornly near 3%. Effects on transmission and mortality are anticipated to move higher again due to continuing indoor business and education activity openings and the advent of cooler weather, which implies people staying indoors more and in closer proximity to one another. A larger second wave of infections is clearly gaining momentum in Europe. India is having a rapidly increasing number of cases, and due to widespread crowded living areas and impoverishment, will have a more difficult time controlling their outbreak and the consequential economic effects. With a population 4 times the size of the USA's, it is very likely they will have the globe's highest case and fatality counts very soon. Globally, we expected cases to reach 35 million, which they have, almost doubling in just 2 months from 19 million at the beginning of August. At this moment, there are over 200,000 new cases being reported daily. By the end of the year, it would be a reasonable expectation for global case counts to reach at least 60 million, perhaps much higher. Global fatalities have reached past 1 million, and it is likely that this number will nearly double by the end of 2020. Last month, we mentioned the downplay and happy talk surrounding the pandemic situation. However, reality came home to roost when the president and over a dozen of his personal contacts began reporting positive COVID tests and symptoms. Given the latency time between exposures and the evidence of infection, this situation will likely expand to encompass many more individuals within the highest ranks of the U.S. government, as well as individuals who attended trips, meetings, and rallies which were held during the initial phases of this infection vector. It is only through the availability of extraordinary care and application of new experimental treatments that, so far, have prevented more serious consequences. Given that this is a clear demonstration of the consequences of ignoring best medical advice, we should be more realistic in our own expectations. It would be optimistic to presume that under the best of circumstances, it will be mid-2021 or later before large numbers of people can be given one of the vaccines currently under trial, and that it will be late 2021 or beyond for an available national vaccination program. So that now includes the entire 2020 flu season, as well as the beginning of 2021's. We will hope no new extraordinary challenges show up due to global vigilance being at new highs. Now, the current economic environment. In September, unemployment levels declined again somewhat to a national level of 7.9%, with most of those returning to work having been temporarily furloughed or had their hours curtailed from their jobs in mostly service industries. Many more of the remaining temporary layoffs have become permanent ones, and the hardest hit industries have begun another round of permanent layoffs. We anticipate that during this fall, return to work gains will flatten further as outdoor seasonal work hours decline, anticipating additional issues arising with educational and business reopenings and a fresh set of holiday-related infections in the ensuing weeks. We expect unemployment will slowly move back up, returning to the 9 to 10% area, where it will stubbornly remain far into 2021. With winter weather already arriving in some locations and newer, cooler temperatures which are not as conducive to outdoor dining, many establishments for dining and entertainment will face new pressures to control coronavirus transmission indoors within their facilities, and will certainly face operations at substantially reduced capacities and sales volumes. We'll have to wait for further developments during autumn. As anecdotal evidence, we have noticed that traveling entertainment shows, comedians, music acts, etc., have either outright canceled or pushed new show dates out into late 2021. Indoor conventions and convention center businesses are literally dying, with collateral damage to closely affiliated hotel and restaurant businesses. Airlines and major amusement venues have begun massive layoffs to the tune of multiple tens of thousands per company. Automobile sales during the summer months were moderate, recovering up from a dismal second quarter, but still ended the third quarter down 7.5% compared to third quarter 2019. Fourth quarter results will point to either stabilization of this key industry or towards further decline and layoffs. Equities markets appear to have peaked at this time. New highs were set in the first 2 days of September, and then the markets retreated about 5% during the rest of the month. We issued a blog in late September about potential market responses to election results and would refer you to that for details beyond what we normally include in our analytics. Markets will likely pick up in the days ahead of early third quarter earnings, but are most likely going to move down again as those earnings are not going to be stellar, and then the election results are to be factored in. This is going to be a very interesting 4 weeks. Between the emotional influences of the political election and the pandemic and the soon-to-be revealed facts of earnings and forward guidance, it is a mere guess as to where they will be by the end of October. Now, for our individual indicators, our AP stock index indicator looks at the relationship between current month-end S&P 500 equity closes and the ones from 4 months back, as well as comparisons to a set of long-term growth rates. Last month, we published twice about the 3 indicators we use to establish whether the markets have entered bubble territory. That is the best place to look for details, but we summarize here that the highs set in early September forced the tripping of our third of 3 indicators, and that the subsequent minor retreat of the markets hasn't changed that picture. New tests of those high figures may occur prior to the election. September's closing value for the S&P 500 shows up as a yellow indication, with that index in warm but not blatantly overheated territory. Look for a return to red if that index closes out the month either above 3550, that's highly overheated, or below 3100, which would indicate a downward correction. We'll be watching market performance and growing margin borrowing levels, our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the 2 large corrections of 2018, both of which we predicted. In the third quarter of 2020, margin debt soared by 33%, absolutely flying in the face of the reality of recession and overall prospects for the economy. At $650 billion, margin debt is a mere $50 billion away from its all-time high of $700 billion, set at the end of 2017. Right now, it is right where it was when we warned of the first market correction of 2018. Circumstances are vastly different now, but heavy margin borrowing synchronized with market at highs is a likely driver for a market correction beginning, quote, soon, unquote. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. Now, with regards to our other indicators, the Federal Reserve's weekly aggregate measure of economic stability has returned to a position of relative safety, but the Fed itself has remained with the NBER declaration of recession within all of their data sets. Fed charts for other data that we observe clearly show they have not cleared the bottom of the recession, and Recession 2020 is now 8 months in extent, per the NBER. Therefore, our AP FD indicator for this report remains red, now for 7 straight months. The AP MS money supply indicator remains solidly green, as the Fed continues to with their expansion of the money supply, but at reduced levels, ending the federal government's initial financial stimulus package and outlays that came to well over $2.2 trillion. The Fed continues to buy corporate debt, but at far lower levels, tens of billions, rather than the originally announced $4 trillion purchase facility they allowed for. It also continues to warn Congress that the bottom layers of the economy are still suffering, and the whole economy will suffer more if no new and significant stimulus is injected there. Additional stimulus has been dangled at us by some of the Congress, but just as we are writing this update, negotiations on further stimulus have been called off by the White House, and there has been an immediate negative reaction to putting off any further stimulus hopes until after the election. The GDP rate dropped during the second quarter to $19.4 trillion per year and was down from the $21.7 trillion per year, a rate established 9 months ago. We expect further declines in both the GDP and the velocity of money. These are sure harbingers of a deeper and more protracted recession. By the end of October, we should have new values for each of these two key economic parameters, and we'll have a better view of how they compare with our internal projections for each. Precious metals have mostly cooled a bit, as all were showing upward price movements at surprising rates of increase earlier this summer. Gold spent all its time between $1,860 and $1,960 per ounce in September, down from a temporary push above $2,000 per ounce, penetrating that mark for the first time in history. Silver corrected similarly, down around 10% over the month. There will likely be some additional pullbacks in precious metals along with equity market declines as speculators voluntarily or involuntarily sell off. Rhodium continues reflecting some speculative upturn for the time being, remaining near all-time high levels. Month-end pricing for gold and rhodium keeps our AP precious metals indicator well into the red. The August leading economic indicators from the Conference Board again improved slightly, but for this report, our APLI indicator remains solidly red. We expect declining LEIs to return within the next few months. The Conference Board also warns of a flagging recovery and that we should expect a weak economy well into 2021. Due to the collapsed yield curve, our APYC indicator remains yellow for June. All Treasury yields held at levels very similar to last month, moving down only a couple of basis points at worst. Some analysts suggest that these continuing low rates, along with the huge drop in the velocity of money, presages another big hit to equities. We shall see. Timing the next big leg down is a risky business. We know it will happen, not precisely when. Something will have to spook the markets further, and a large initial wave of selling would probably do the trick. Now, in summary, only one of our 6 indicators is in green territory. We are keeping our probability of a near-term recession at 100% because clearly we are still in a recession. We calculated that the actual onset of recession had already begun almost 8 months ago, a fact which was then confirmed by the NBER in June and became officially acknowledged by the Federal Reserve later in the summer with the adoption of the NBER's declaration within the Federal Reserve datasets. Further modifications to this scenario will depend on what happens in the days and weeks ahead, but events are highly unlikely to change the outcome of what has already been set in motion. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008 within the context of an unbelievably risky economy, just as we are facing now. Just like then, we also face an election which portends a shift in administrative policies. This time, there is the unique backdrop of a pandemic and ongoing political manipulation of expectations for additional beneficial economic stimulus. We maintain that this is a very risky equity market environment with the potential for significant and protracted drops. High speculative valuations never persist, and a return to the mean, or worse, becomes more likely with each new disruptive influence. Well, that's all for this month. We, of course, have the big event, the 2020 election, between now and our next report. So we'll see what happens, and it should be, as we said, a very interesting 4 weeks. So please look for us in the later days of the first week of November for our report at that time. Thanks for listening.